Welcome back. Today is the last day of a very busy week in U.S. corporate earnings. And as has been typical for a couple of years now, the spotlight has largely been on the huge tech players. Alphabet, Microsoft, Amazon, and Apple have all reported this week. Let's talk about it with Thomas Martin, Senior Portfolio Manager at Globalt Investments. Thomas, thanks a lot for joining us. We've seen some disappointments. We've seen some excitement. AI is largely at the center of this. There has been some apprehension about large CapEx numbers being devoted to AI, but we're also seeing some of these companies seemingly deliver with their AI. What's your take on this week's big tech earnings?
Well, thanks for having me on your show, Paul. My take is that it's all actually pretty positive, notwithstanding the market reaction yesterday, and particularly to Microsoft and to Meta. But their quarters were, in my view, fine in terms of just their business, in terms of their revenue growth, et cetera. And like you said, the CapEx numbers were the thing I think that people were going to watch again in aggregate for the individual companies, but also to see just how much money is being spent and what the body language is for continued future spending, which is more going forward, and a reiteration of the importance of that spending in AI and in data centers and processing and in the models and in using AI for their clients. So that all is very much alive and well. I think that, again, notwithstanding yesterday, which was maybe sort of a Halloween temper tantrum, the market's back on better footing, and NVIDIA is up, which is, to me, an indication that the AI infrastructure game is still on.
So it sounds like you believe investors should be maintaining exposure to this sector. How much exposure is appropriate?
Well, we are overweight Meta and Microsoft and Amazon and Google, not Tesla and not Apple. There's really different things going on. So you have the hyperscalers in particular, plus Meta, which are all in the thick of things with AI, whereas Tesla's kind of marching to its own drummer, and Apple, is executing, but it's all dependent on the iPhone 16, and things there, as far as AI go, just really have been a bit on the disappointing side. It's going to take a while to get the software and the hardware working together to do the things that will really sort of start to amaze people. So we're underweight both of those names, but overweight the others.
I know in some of your recent writing, you have focused on the financials as well, the U.S. financials. They've had a pretty good year as well. What are your thoughts on the bank stocks? It's been several weeks now since we had results. They kicked off earnings season. It was essentially a positive quarter for the large money street banks, money center banks. What do you think of the big banks?
Well, the reports were good, and part of what was good was just some of the comments that things were getting better or bottoming in certain parts of their business, and that the outlook for 2025 was good. Investors are skeptical when managements make those comments, but I think that analysts and portfolio managers felt the same way, and the stocks reacted positively. With the election next week and with the potential outcome maybe favoring the Republican Party, if there's less regulation in the financials, that is sort of a tailwind behind them. So I think that's part of the reason why the stocks are hanging in there and doing well, that and the outlook. So it's a pretty good combination.
The healthcare sector has a history of being affected by headlines that get generated in an electoral campaign. I'm not sure there's been many of those headlines this time around. I'm not aware of any vows to bring drug prices down. But what are your thoughts on the healthcare sector, a very diverse sector in the U.S., and one that in the minds of investors has been dominated by the weight loss drugs for some time now?
Right. Well, certainly. And so Lilly is just, the front and center star of that. And the stock got pummeled day before yesterday with regard to some, their earnings. And particularly with their weight loss drugs and not meeting expectations due to inventory adjustments, et cetera, and trying to match supply with demand according to the company. But also valuation comes into play with that company as well. So because there is such great opportunity there and the growth rates for revenues and for earnings are very high, the stock has really gone up and up and up, and as a result, the multiple is high. So there's not a lot of room for slippage there if they miss, or for doubts, or for wondering about competition, et cetera. But it looks as though the market there will be good for them and for the others. There's plenty of room for these drugs to be well in demand. What we've seen in healthcare is a lot of volatility, and it's around these announcements, and the names move quite substantially in one day. So I think it pays to step back and look at what the underlying fundamentals are of the markets that they are addressing, and then how they're going to be competing longer term. And to that'll give you the staying power to stay in the stocks when you need to, when they get knocked around a bit.
That's Thomas Martin. He's joining us from Atlanta, by the way. We will take